You were involved in frontier markets, and you're always looking at what markets are good for investment. So, how do you look at a stock or a country and decide that that country is fit for investment? I mean, how do you gauge the valuation of that?
Well, it's not always obvious, but occasionally there are cases when there is an obvious undervaluation of equity prices and property prices. Say, as an example, in the late 70s, there was a boom in the Philippines and then a collapse, and then the currency collapsed and the stock market collapsed in the final years of the Marcos regime. And then by 1985, the entire stock market value of the Philippine share market was less than 500 million US. Then you could obviously say, okay, we have problems in the Philippines, but stocks are very cheap. Similarly, in Latin America, we had after 1978 a period of accelerating inflation during which the currencies collapsed and shares also performed miserably. As a result, in dollar terms, the stock markets of Mexico, Argentina, Peru, and so forth became incredibly inexpensive in the years 85 to 87, also Brazil. And so you can go to these countries and you look at the market value. At that time in 87, the market value of Argentina was 750 million US dollars, the whole stock market. So you don't need to be a professor at the university to see that there was a low valuation. Doesn't mean that it will necessarily work out, but at least you buy at the low level.